My name is Muiba, and I welcome you to this year's investment strategy webinar titled The Pricing Paradox, Strategy for Return Maximization. As usual, we have to take a look at several macroeconomic events so far in the year, both in the global and domestic space, and how these events have actually affected the financial market, somewhat shaped the markets. For that, we have our investment professionals that will be taking us through that step by step. So our first stop would be the global macroeconomic space, and I'm sure Raymond Okpara would be glad to take us away. Raymond?
Okay, thank you, Mila, for that intro. I'll be taking us through the global macro and market outlook, focusing majorly on major economies. So starting from inflation, inflation remains a top concern, across the globe. And we've seen that across 2024, while headline inflation, has eased and expected to ease at year end, core inflation still remains elevated. And this is as a result of sticky wages, and also you're seeing some persistent service sector costs. All this, including energy prices, could keep inflation dynamics quite tricky for the year. All in all, we expect that also geopolitical risks, could be another problem that could keep inflation above the Fed's 2% target. But going into growth, we've seen that through the cycle, the US economy particularly has faced, a potential slowdown, as we've seen tighter monetary conditions, across board. And these conditions have continued to weigh in on consumer spending and business investment likewise. While we expect a soft landing and believe that that is still very possible, there are risks of a mild recession, and this could take the center stage if, interest rates stay higher for longer. And for monetary policy, we have seen over the course of the era that is now the time for monetary easing, as inflation has ticked low to desirable levels, although not at the desired level yet, but we've seen some improvement across UK, Eurozone, and BRICS regions. We've seen that interest rates have peaked in Q3 2023, for these select countries, except for China, where there's still some issues on the rebound from COVID. Economic activity has not been as buoyant, and monetary policy activities in line with also fiscal actions, particularly on the housing sector, have all been on the front stage to boost growth. But long and short, we see that if inflation continues to decline meaningfully, the Fed could start cutting rates, and continue that rates, start cutting rates, even and continue from late 2024, although they remain very cautious so as not to reignite inflation pressures. And then speaking to Trump, on the political front, we've seen, Trump winning an election against Kamala, but we understand that this presidency could introduce some market volatilities. Trump is very big on trade tariffs. Trump is also big on deregulation, and fiscal spending, and this could reshape, the inflation expectations and global trade dynamics, all in line with investor sentiments. And, this could create both opportunities, for investors to key into markets, but also the risks are also, we also watch the risks very carefully to see, how this new Trump 2.0 impact would affect markets. But we understand that for corporates, we expect that Trump's tax cuts will boost investment activity. On household, we understand that Trump is key on energy regulation, and this could mean lower costs for houses in the short term, but pose long-term environmental risk. Also on the government, Trump spending could lead to a larger fiscal deficit, due to the rollback of the Inflation Reduction Act, and also we might see some regulatory issues on the executive side. And for international trade, we all know that Trump is big on, being US as a funds bearer, anything concerning economics and global trade. So we understand that his trade policies could, reignite some global supply chain issues. And this also might strain international relations, with China, and, as the build up to the potential tariffs that, he has highlighted. But all in all, for the global outlook, we have highlighted four major keys that will shape 2025, starting from inflation. Global headline inflation is expected to decline further in 2025, despite potential headwinds from rising energy and housing costs, provided that no significant disruptions or unexpected shocks arise. And then on global growth, the recession obsession is slightly fading, and global growth is projected to remain stable in 2025, with the IMF forecasting a 3.2% expansion, same level as 2024 expected ending, unchanged from 2024, and the world will continue to, contend with greater uncertainties in line with global trade and geopolitical tensions, which are the major risks. On monetary guidance, we're seeing that the central banks paying key attention to inflation is a very data-dependent regime, and you see that as inflation moderates, policy rates are expected to gradually decline to levels that foster, both healthy labor markets and also overall economic growth. And last but not the least, we're taking a look at geopolitics. We understand that Trump's victory may suggest that globalization may be further threatened in 2025, because Trump is very big on additional tariffs, and we might see that intensification on major trading partners like Mexico, China, and Canada. That brings us to the end of the global market. We're going to the domestic economy.
Thank you very much, Raymond. That was quite insightful. Well, as we've seen the inflation trend in many countries and monetary policy actions by different central banks, how about we take a look at the home front, Nigeria? Is it the same story? And if not, should we expect Nigeria to take cues from the global space? I'll let Babajide Atolagbe shed some light on that front.
Thank you so much, Wibat, and thank you so much, Raymond. You had a very valid question on whether Nigeria is following the same story. The answer is actually yes. The question is that issues are quite extra magnified when it comes to Nigeria. Yeah, we've seen how global growth has remained slow due to the fact that we see monetary hiking. In Nigeria, this is the case as well. However, we've seen that in the last quarter, GDP grew at 3.5%, which is comfortably the highest quality in the last couple of quarters. And the rationale behind the growth is relatively simple. We've seen increase in the production numbers from the oil section. We've also seen some improvements in the service sector as well, but we continue to see weakness in the manufacturing space, and that is largely tied to the difficult business climate in the Nigerian economy, that is largely tied to inflation, also the fact that interest rate is at record level. Speaking much more on the oil sector, it has really accounted for it. You can see from the production numbers that in the month of October, our production number surged to as high as 1.3 million barrels per day. Right, we're coming from as low as 1.1 something like last year. However, despite the improvement we've seen, it's still relatively shy of OPEC's quota of 1.5 million, and this largely tells us that we need more. We need the government to be to increase the accretion in terms of production, and also ensure that the activities of the oil producing regions are kept efficient. In terms of inflation as well, right? Inflation is a global phenomenon. Yes, that has been the case since 2022. We saw it run down 2023 as well, and 2024 is not different. But in Nigeria, inflation in Nigeria has actually worsened to all-time high of 33.8% at the last reading. And this is not necessarily far-fetched. The factors, the policies that have been implemented by the government has brought about some, better pricing in terms of, the FX markets, seeing inflation, come from the FX markets. Food producing region as well are still challenged. and the infrastructural deficit in the countries also continues to pressure inflation. So all of these factors have pushed inflation to as high as 33.8%. And despite the effort we've seen from the central bank to address this issue using monetary tools, that has not really given any serious buffers to the market, as inflation still remains astronomically high. And the outlook is not necessarily interesting as well, because these pressures are still right in front of us. Speaking of the monetary policy as relates to the FX market, yes, we know how this year has been in terms of the government trying to ensure we have a market reflective exchange rate, unified exchange rate, and all of that. And of course, we anticipated that the effect of that will mean that the naira will continue to trade based on supply-demand dynamics. And the current situation or the currency on the market, evidently shows the fact that the main demand continues to outweigh supply, and the primary sources of supply still remain challenged. Speaking of from the trade side, also speaking of foreign capital importation and thereabouts. So the current pricing in the FX market shows that CBN still needs to do so much more in terms of servicing all these segments of the market. And we've seen how they've used monetary policy to attract FPIs. Although that has brought in some numbers, but does not necessarily cushioned the volatility we see in the FX market. So we really need more ingenious approach to addressing the situation. Historically, we've recorded one of the highest trade balance over the last 10 years. Our total trade sums up at 6.9 trillion, right? And it's largely tied to the policies that the government has introduced that has opened up the economy much more, and has seen the influx of new businesses in different areas of the economy, and also partly due to the fact that the currency devaluation has also increased the number. So I mean, the story is still the same. We need to do more in terms of trade. We need to export more, and we also need to substitute imported product for locally made goods. Meanwhile, in terms of capital importation, I think I tried to touch on that. We've also done well. I mean, relative to the past, few quarters. This is, I mean, we give credit to the central bank, given the fact that they've hiked interest rates. And this is attracting flows. You can see that majority of the flows are coming from foreign portfolio investment and other investments. So we think that this is, while this is good for flows, it's not necessarily sustainable, because this is coming at a cost to the government, and also at a cost to the liquidity, because this is likely going to increase the velocity of money in the nearest term. In terms of the fiscal angle, the government has actually done well in terms of revenue accretion. However, when we compare our debt service revenue, it has somewhat improved, somewhat in the range of 60.2%. Previously in 2023, it was as high as 83%, which we've cried about the unsustainability level in the previous years. 2024, much more better, and that is tied to the fact that revenues have improved, and debt levels have also not jumped like we've seen them in the previous years. The budget target performance, well, in terms of 2024, I think many of the indicators have quite underperformed. GDP growth, well, we looked at 3.4, we look at 3.7, and we have a 3.4. Exchange rate has woefully underperformed. Oil production is still shy, and inflation is still at record high. So 2024 has not been a year that our public policy decision makers can really say they've really done well in terms of the target we set for ourselves. And in 2024, I mean, the optimism still continues in terms of revenue. 12.7 trillion we achieved so far, and we're looking at rounding it about 13.1 trillion for 2024. We've also spent over 23.4 trillion, between January and August. And when we look at the 2025 budget as well, we think that the forecasts are quite optimistic, particularly the revenue side, while every other assumptions are quite achievable other than oil production. So we still think that oil production of 2 million barrels per day, we're currently at 1.3. We think so much more can be done to get us closer to that level. Oil prices are $75 in 2025. Neither here or there, I think it's largely due to excellent event and how Donald Trump's administration is going to tackle energy sufficiency in the US. Inflation at 15.7%, 15.75% for 2025 is somewhat a far cry. I don't think we can get there, given the fact that pressures are still existing. And I think that even if inflation is going to moderate in 2024 due to low base effect, it can get to as low as 15.75%. So the government really needs to see how they can achieve all of these assumptions without jeopardizing the current state of the economy. Outlook for Nigeria, growth still likely to remain between the 3% region, to be driven largely by oil production as well, and the improvement in service sector. Manufacturing is going to remain below the output gap because of interest rates and the challenges we have. For inflation, we think that inflation would I think we've seen the peak of inflation in 2024, and that from the second quarter of 2025, we might see inflation moderate due to low risk, due to high base effect. In terms of fiscal policy, we've seen the government also ramp up revenue accretion, a lot of policies on taxes, and ensuring that all the loose ends are being tightened. We hope to see how that will in fact impact the fiscal deficit in 2025. And for monetary policy, we also think that we've seen the best of the hiking days, and starting from 2025, particularly in the second quarter, the CBN may start to consider easing those rates to ensure that the economy is also back to normal levels.
Babajide, thanks a lot for the elaborate presentation. It was quite informative. Now that we are abreast of these macroeconomic developments, let us see how all of this put together have actually affected the markets, somewhat shaped the financial market so far. And we will have Raymond Okpara once again take us through that. Raymond?
Thank you, Muiba, for that. We're going through the global markets, starting from fixed income. So what we saw in 2024 was that fixed income markets faced some I'll call volatility due to persistent inflation and also aggressive rate hikes by the select monetary authorities, including the Federal Reserve. So what we saw particularly in US Treasury yields saw a peak, before declining on expectations that, there will be some sort of policy easing. But looking ahead to 2025, we understand that, long duration bonds are particularly poised for gains, if central banks follow through with the rate cut cycle and start, and begin cutting rates. We also see that corporate bonds could also benefit from this, as we've seen narrower spreads on corporate bonds, and we should expect all that to rebound on improved economic activity. And for commodities, we understand that commodities experienced a volatile 2024, driven majorly by geopolitical tensions and somewhat supply chain disruptions. We understand that oil prices remain elevated, due to OPEC cuts as well as geopolitical shocks, while we saw for metals like copper and silver, they have benefited from a yen for more infrastructure and also cleaner energy investments. But all in all, in 2025, we project that oil prices may remain strong, as oil prices may still remain strong as a hedge, against all the geopolitical risks. And we've seen that the energy sector, as has been marked by geopolitical tensions, we expect that going into 2025, there may be some improvements if we see improvements on inflation and also geopolitical tensions. For currencies, what we've seen was that the US dollar has continued to gain. It strengthened in the first half of 2024, coming from a weak 2023, where it recorded a negative 0.3 year-to-date performance. And that was all in all, we saw that improvement majorly due to the Fed's hawkish policies. And like I mentioned before, markets anticipated a major policy pivot, which didn't, crystallize. But what we've seen is that major currencies like the euro and yen, gained momentum against, the central bank adjusted policies. And in 2025, we expect the dollar to weaken further if the Fed begins rate cuts, and this should also boost currencies for emerging markets that are tied to this, let's say, commodity and also global trade. And then for real estate, what we see in real estate is that the high interest rate environment as a whole has pressured housing prices. We're seeing that commercial and also business real estate, continue to struggle due to a range of factors, starting from financing and also a declining demand, for these spaces. But in 2025, we believe that in 2025 maybe we'll be faced with, falling borrowing costs, and this should revive, those segments. We see that residential properties in 2025 should receive, renewed demand, and this could also attract investors that are seeking to, reposition opportunities or are seeking, to buy distressed assets. And just going to equities, equities faced a challenge in 2024. We saw slower earnings growth and also higher interest rates, have weighed in on devaluations for equities. But what we saw at the later part of the year was that US stocks, particularly tech stocks, staged a late year rebound, so to say, as we saw on the back of expected rate cuts, while we saw healthcare sectors and utility sectors, remaining quite stable. For emerging markets, we saw that emerging markets saw selective gains, driven majorly by Asia. We saw some recovery efforts in Asia. But all in all, in 2025, we believe that equities may experience a broad-based recovery, majorly led by tech, clean energy, and financials. We expect improved earnings for these companies, and an easier, or so to say, an easing monetary environment could drive, performance with these markets. I think that's the end of the global markets. Take it on to Jay.
Thank you very much, Raymond, for the presentation. It's been insightful so far. Now that we've seen how the global markets fared, it's time to take a look at what our local markets did over the year, and especially which of these markets actually proved to be a darling against all odds. Is it the equities market? Is it the fixed income market where we have our bonds, our money, our bills? So would have a birthday at Tolagbe take us away one more time. Thank you.
Yes, thank you, Muibat. Right. And for the domestic market, right, we saw some sort of the market actually tracked the fundamentals, right? Starting with the domestic bonds market, the storyline very simple. As the central bank continued to raise interest rates, the NPR from time to time, we began to see bond yields also go higher, right? And I mean, the last hike, took us to as high as 27.5%. And, inflation at 34%, we saw bond yield also track from as low as 18.9% in January to 21.5% in October. So at almost every point in time that you buy bonds, right, other than the yield you've derived, there's little or no room for capital appreciation. And the continued hike that we saw over time, also had a significant impact on how the yield curve, panned out for the most part of the year. We had a situation whereby, the curve is still currently inverse, right, with the short end and the midterm having higher yields because of the maturities that the central bank, the maturities that the government, were issuing 2033, 2031, 2029. So we saw that the short end, the medium end of the curve were much more attractive because of the activities of the DMO. Meanwhile, the long end, pretty much remained sticky for the most part of the year. In terms of the money market as well, treasury bills rates, I mean, from the demand pattern, we see that investors were just trying to play the catch-up game as inflation was, deteriorating, as central bank was increasing rates. We saw bids at, the money market space also, track higher. And this also had a significant impact on the commercial paper space as well, as we saw a lot of corporates, A-rated corporates, raising instrument, 270 days instruments as high as 30% yield. Even the best issuer in the country, which is Dangote Cement, and also MTN, were issuing north of 20%. It shows how difficult it is for issuers at this point in time. So I mean, the market, the fixed income market, money market, it's a game of yield for the most part of the year, and we think it's still going to be like that for over the next couple of quarters. Everybody has their eyes on inflation and also has their eyes on what the central bank is going to do. Meanwhile, for equities, I mean, this market has always tried to compensate for inflation, and we saw that happen, again in 2024. At the first quarter, we reported that the NGX reported as high as 9.8%, sufficiently above inflation at 1.7% as at then. But as inflation, worsened, and as some corporates, restructuring events were happening, as market sentiments were pricing in, we saw that the return on the NGX has moderated to 30.6. So far, so good. This is still, one of the most, high, return public securities that has come close to, inflation, when you look outside the money market space as well. And we think that going forward, the NGX market as well, still the best place to play in for investors that are seeking to beat inflation. In terms of sector performance, yes, oil and gas sector, dominated sentiment. You could see the, sector indices. The sector index went as high as 128%. Insurance also followed suit. 42% for consumer goods. But banking was quite slow this season, and I think that's largely due to the corporate actions that happened. I think most of all the investors that bought stocks within this period must have gotten their orders filled at the primary issuance level. So the secondary market did not necessarily jump higher. So that's about it for the fixed income and the equities market for 2024. Going forward, we think that for both developed and domestic fixed income, the activities of the central bank will largely dominate how prices will play out in that space. Meanwhile, for equities, there are some discussions around equities being overpriced or not overpriced, but I mean the market still continues to deliver strong returns, and we don't expect that to stop in the coming years. For commodities as well, I think geopolitics will still remain the major focal point for 2025. And I think that, how well every other country plays their card with Donald Trump will shape a huge part of our financial markets in the coming year.
Thank you very much, Babajide. Well, I'm guessing we are getting to that part. I mean, the main reason why many of us are here. We want to know what really is a pricing paradox and how do we maximize returns in such economic phenomenon? I am sure Temitope Omosuyi would be glad to shed light on this.
All right, Muiba, thank you very much. So I think what investors are concerned about right now, globally, and even in Nigeria, is when will yield turn, especially on the global level. There's a lot of apprehension about, Trump's tariff and its implication, and when the Fed, among other advanced economies, Monetary Policy Authority, will begin to cut interest rate. So looking at what has happened so far with monetary policy rate and inflation, you would observe that prior to 2020, inflation used to be way above monetary policy rate, but right now we are seeing a situation where inflation has declined substantially, closer to the 2% target, while monetary policy rate is still elevated. In other words, the policy rate is becoming highly, restrictive. In fact, if inflation continues to decline and policy rate remain above, say, 4%, it means that policy rate is becoming tighter. So we think that this will continue to inform policy rate going forward, not just in the US, in Canada, in the UK, among other countries. And we think that more rate cuts would definitely happen next year. So moving on to the paradox we observed in the market, we noticed that Babajide noted that in addition to what Raymond said, that we've seen some positive sentiment in the stock market this year, and they are largely due to the performance of about 30% of the S&P stocks, and that has resulted in some sort of pricing paradox in the market. If you look at the illustration we have here, you would observe that prior to 2023 and 2024, the spread between yield on fixed income with peak 10-year yield and S&P 500 is usually, was quite high. That is, you will have more of NEC yield. So NEC yield here is just the earning per share divided by price. So any yield was higher than yield on 10-year yield. But we are seeing, we've begun to see some reversal since 2023, and that is still prevalent in the market. In other words, there's there's some sort of abnormality in the market. And what do we expect to happen? Two things can happen in this kind of market situation. It's either yield on any yield on S&P goes up, and if that's going to happen, it means price will drop in the market, because any yield in this context is earnings per shares divided by price per shares, right? If that happens, it's not going to be good for investors in stock. But the more interesting part is that, in fact, even at glance, what is easily achievable is for yield to decline. And if yield decline is to benefit fixed income investors a lot, especially investors that choose long duration instrument, because what it means is that if you decline, you're going to make a lot of money, or you get higher return when you stay on the long end of the curve. And that's what we think will play out, because this mispricing, or this kind of pricing paradox, cannot be sustained for too long, because the expectation is that next year, policy rates will reduce and market rate will also catch up with some of these fundamentals. In addition to that, some challenges are already quite obvious in the US market in terms of what is happening in the real economy and the lag impact of higher interest rates. So, there's also a conversation about how Trump policy would affect inflation. Everybody's apprehensive and all that, but we are quite abreast of some of those pressure points. We know that there's the conversation about trade war. We are also abreast of the fact that our tariff would be imposed on so many trading partner of the US, and Raymond alluded to some of them. We've seen some announcements on Canada, Mexico, and a lot of impending ones that would be placed on China. We are also, there's also a conversation about tax cut, because Donald Trump is looking at a situation where if there's going to be sanction or tariff on certain sectors of the economy that are strategic to the US, there has to be tax cut, more like subsidy, to support local industries or companies that are able to cushion the impact of that of the tariff. So there's going to be tax cuts. People are already thinking, investors and market watchers are already thinking that a tax cut could put more money, because once tax is cut, there's more profitability and there's more dividend to be paid to shareholders. So that could be inflationary. That's what market is already thinking. And in terms of immigration as well, there's a concern that right now the US market, the labor market, is very tight. 4.2% unemployment rate as at the most recent reading, and that's more like the lowest so far. In fact, that's their natural rate of unemployment. So all these factors, especially in terms of the migration, this is expected, the deportation of illegal immigrants to the US is expected to somewhat affect the labor market. So all of these are concerns by investors and market watch. And I know that everyone on this call is also trying to figure out how all of this would affect inflation and interest rate nested, because once you're able to ascertain some of these things, you can easily navigate your investment choices. So we try to look at least a few factors, because the best anyone can do right now is to try to picture what happened during Donald Trump's first administration. That was between that should be 2017 into 2020, right? So about that time, right, we try to look at how the tariff on China really panned out. Were those tariff real inflationary? So we look at the numbers and we observe that they were not really inflationary, because if you listen to a lot of market watchers, that's the apprehension. In fact, if you look at the trend we have here, right, immediately Donald Trump got to the Oval Office, he announced about 25% tariff on China, and we saw a couple of that all the way down to 2019, right? But if you look at inflation trajectory, it's just hovered around the 2%. As a matter of fact, if you compare the average inflation under Donald Trump with Barack Obama, you see that it just went up slightly. It was still within the 2%. And so what do we think in general? We think that fundamentals would prevail next year. We have earlier highlighted during the global macro presentation that oil prices, global economy will remain stable and oil prices could be on the back foot. And we all know that what brought us to the major spike in interest rates and inflation was the Russia-Ukraine crisis in 2022. So we think that as much as fundamental, we think that market is fundamental, mean reverting. However, sentiment would have a role to play. So for all of these, Robert will help us put them together for specific actionable strategy to deploy in 2025. Thank you.
Thank you very much, Temitope. That was enlightening. Now that it is clear that there's a pricing paradox, where do we go from here? What do we do to stay invested and have successful investment? What is successful investment? Have return, yield positively on what you've invested. So I would allow our Chief Investment Officer, Robert Omotunde, equip us with effective investment strategies to take with us into the coming year, 2025.
Thank you very much, Muhiba and Temitope. So it looks like I've been given the smallest but most difficult job to do, which is why I believe that most of people on this call would want to be enlightened on. But I think it is already clear that the pricing paradox we refer to here is the, so to speak, the differential between what we think the fundamentals should look like as compared to what the market is really pricing. That is fundamentals versus sentiment. And I like where Temitope left it, which is to say, our prognosis for 2025 is that we believe that fundamentals will take the center stage. And if fundamentals will take the center stage, it's important that investors are aware of where to be invested. It's much more interesting to know which asset class will be most benefiting to the investors. So, but I mean, before we look at that, some of the strategies that we have crafted out for 2025 is shown right now on the screen, and I'm just going to start from the right. One of the things we need to be aware of in 2025 is that we have to stay invested. Investors must be invested in order to benefit from whatever will come out of the market. 2025 doesn't look like that year where investors will stay in cash. A part of this year, some investors took the strategy to stay in cash. And staying in cash, meaning you're investing in nothing, was in itself a strategy, because some investors were able to, circumnavigate some of the choppy terrains that we saw in the investment landscape in 2024. But going into 2025, having established now that fundamentals and sentiment are at play, and that sentiment is not going to have as dominant role as fundamentals would have, then investors would need to stay invested. And then in staying invested, not just that, you have to have a strategic position about the market. So, in investment, we always talk about your strategic views as against your tactical view. In 2025, this is a year we believe that strategy is going to win. Strategy is about the fundamentals you believe in, that you are positioned in as at when you're supposed to position. Now, it doesn't matter whether sentiment is flip-flopping. It doesn't matter whether we have volatility in sentiment, but you believe that fundamentals will take its course, and at the right time that as you're going into the market, you take that strategic view and you position in it. We believe that's what investors will need to do in 2025 in order to benefit. Then timing can never be overemphasized. We're at a period now where we think that global inflation is easing across board. We still have pockets of pressure here and there, but we think that overall the inflationary pressure that the market has experienced for over the last 2 years is now beginning to moderate, as we have seen that happen, in the European countries. We've seen it in Britain, we've seen it in America, and we're seeing it in some, other parts of sub-Saharan market, Nigeria being an exception. And even for Nigeria, on base effect, we are expecting that inflation could moderate, but only on base effect. So timing the market is very much more appropriate. Then the point will be, what is the right time to go into the market? We say the time is now. If you're going to stay invested and you take your strategic view about the market, then this is the time to invest in the market. I pick one of the asset classes, for example, the fixed income market. The market is still currently trading at about its highs over the last 2 to 3 years. So which means that if you're invested at this time, believing that your strategic positioning will work, then this is the right time to invest and no further delay. In terms of diversification, you won't put all your eggs in one basket. That's how a proper portfolio should be structured. So you're not just invested in one asset class, you're diversified across asset classes. Even within the same asset class, you're also diversified around, the various, if it's a fixed income now, you're looking at the different durations and seeing how you can be well positioned, except you are very much convinced about the strategic view that you have taken. And finally, one of the strategic themes we are looking at for 2025 is your monitoring. As much as we have said that the market is going to be, strategically positioned for, and as much as we have said that you need to stay invested because fundamentals will rule, you cannot ignore sentiment. I think the right saying will be that fundamentals are critical, but sentiment cannot be ignored. And so if you're not going to ignore sentiment, you will need to monitor that portfolio from time to time, so that at some point you may need to, take some actions, in and out here and there, sometimes take profit to come back in, just to see that, you are properly positioned across your portfolio. So these 5 themes will guide our movement. And, it looks like we have given you from the last to the end. That's why I took time to explain it, in the proper order. You stay invested, you have a strategic view, you time the market, you diversify, and then you monitor your portfolio. And then not just that, our ideal kind of portfolio, when we look at the portfolio universe, looking at across different asset classes, will be that you invest around 50% of your portfolio to fixed income. Why? Because we think that fixed income is that aspect of the market that has not corrected. Is the aspect of the market where it looks like fundamentals have been jettisoned for some sentiment around, especially around the change of government that will happen in the United States for 2025, right? So that has really dominated the investment scenery. And we think that that is going to change, as we move into 2025, more so that we are beginning to see that the policy of Donald Trump is not likely to be inflationary, as Babajide mentioned and Temitope re-echoed. So we are looking at a year where most investments will be tailored or channeled towards the fixed income market as a whole. In total, I think that, we are allocating about 60% to the fixed income market, 50% to bonds, and 10% to the short-term money market securities, right? On the equity front, we also believe that the equities market still have a bit of pricing to enjoy as we go into 2025, globally as well, not just from the global scene, but also from the domestic scene. And so our allocation to that asset class is just about 15%, just so that you can also benefit from the opportunities. Now, we've done some very small allocation to commodities, to private equity, venture capital, digital assets, as well as real estate. And that's why we believe, for instance, if you look at the commodity space, we think that agriculture may be the aspect of commodities that would deliver that good returns going into 2025. On the other hand, for the classification on real estate, we're at a phase right now where mortgage rate is as high as where the policy rates are at the moment. But we think that as yields moderate into 2025, mortgage rates will also come down, and this may create some opportunities for investors within that space. Albeit our allocation to that, given especially in this climate where it's not so liquid, it's just about 5% overall on the portfolio. And then moving on, when you look at the fixed income strategy, just drilling down into the fixed income strategy, we think that, investors will need to consider mostly sovereign investment in the fixed income space. So our allocation to sovereigns is about 80% of the overall allocation to fixed income. Meanwhile, 20% will go into corporates. And this is because, as we speak, the corporates are, tend to be a bit more defensive, whereas the sovereigns provide the opportunity for volatility. So if you're looking for value, you go to sovereigns. If you're looking for growth, you go to corporates. So, I mean, that's why we think that in 2025, if you will benefit from market volatility, then sovereign is where to go. But while you are invested, right, we also believe that trading the long end as against the short end will give you more advantage. The reason is because we expect that fundamentals will take the center stage. And if that is the case, the fixed income market yield will trend downward as we see the Fed normalizing policy rates. We see the Bank of England, we see the European Central Bank, and even the Nigerian Central Bank. We have no other option than to consider some sort of normalization in policy as against what we are currently seeing. So positioning on the long end of the yield curve will make a lot of sense. Now, if you tie the last point here, which is activity, that is how active your portfolio is in and out, with what we had defined at the beginning of this presentation, we have said that you need to stay invested, not just that you have to have a strategic view, because we believe that fundamentals will take the center stage. So if you're taking a strategic view, it is expected that your activity will be minimal. And that's why overall on the fixed income space, we think that when your portfolio is tilted towards, sovereign 80%, corporate 20%, and then you are trading more of the long end, activity should be minimal. And that's why we've done a 30% allocation to activity. For the developed fixed income market, to be specific, our favor is for the US Treasury and the Euro and the gilt market, but particularly for the US Treasury and the gilt market. Now, we think that if your allocation for the fixed income market in the developed fixed income market should be 70% allocation to the UST and only about 30% to Euro and gilt. The reason is because, for instance, if you look at the gilt market, you see that the gilt market, by the way, for the sake of our listeners, is the bonds market for the UK, that is the United Kingdom. Now, if you look at that market, for example, you see that the US Treasury seems to define the pace, right? It defines the pace, and the UK gilt just follows. So naturally, your portfolio should be tilted towards the US Treasury market, and of course, the UK gilt benefits. One of the ways you can benefit from that, if you're listening to us, through AfroInvest, is to invest directly in these securities, and we can help you do that. You can speak to us. We can help you do your investment directly in the UK gilts or in the US Treasury or in the Euro space. We have mechanisms that can allow you to do that. The other way you can invest indirectly in this is to buy into our AfroInvest discretionary portfolio, right, which tracks some of such investments. With a minimum of $100,000, we're able to do that for you. And I move on very quickly to the equity equity strategy. To the sub-Saharan African market, not equity yet. For the Eurobond space, we have some allocation around Nigeria, Angola, right? So we have Ivory Coast coming in there at the moment, right? And on the corporate space, we have selected Access FBN and the United Bank for Africa as the bonds that investors should look at. As a matter of fact, we think that yields will drop as we go into 2025. Now, not just because of the fundamentals of this sub-Saharan African market, but because we expect the US Treasury market to drop in yield. So that will also just naturally follow. And we think that Nigeria will benefit. If you look at the modified duration for some of the bonds that, we selected, they're quite good. I mean, look at Nigeria with the highest modified duration of about 9.18. That's a very positive one for the overall market, and then that will continue to take center stage. So we think that focusing on Nigeria, Angola, and Ivory Coast will be the right way to invest in the sub-Saharan African market. The way to do it also is to do direct investment. You can contact us. We're happy to do that. The other way to do this is to buy into our AfroInvest Dollar Fund, which is a mutual fund, or you buy into our AfroInvest income portfolio in dollars, and we are able to help you take advantage of this. And then I move on very quickly into the equity space, on the local fixed income. I'm very glad to go to equities. I don't know why. For the local fixed income market, we have seen what we call some higher yields at the belly of the yield curve. The belly of the yield curve here being the mid-term to maturity. And on the mid-term to maturity, we are advising investors to be overweight on them, right? The reason is because the government is very aware that the current interest rate environment is very high. So they are not locking in, they're not borrowing funds from the long end of the market. They are doing the mid end of the market, the 2033, the 2031, right? Because at the point when interest rate moderates, they expect that those yields will come down, and that's why you will see an inversion, right? In fact, what you will see is like a bell. A situation where you have lower yields at the short end of the curve, higher yields at the long end of the curve, and then lower yields at the mid end of the curve, and then lower yields at the short end of the curve. So it looks like a bell, an inverted bell, if you can say that, right? So we believe that that's an opportunity. It's a trading opportunity for investors, right? And in that space, you will see the maturities like 2029, 31, 33, 34. Those are the maturities that will typically favor investors with good modified duration. I think that we can take advantage of that going into 2025. And then finally, I can go into equities. For equities, we have a universe of stocks that we are tracking. And for those stocks, we're putting the reality check of where those stocks are. We've been tracking these stocks over time, all right, and that's where you will see most of the banking stocks are still presenting a very good upside potential as we go into 2025. I will make this available to you so you can trade it. But to be specific, the best way you can trade equities in this market is to buy into a fund. And one of the good funds you can buy into is the AfroInvest Equity Fund, and we'll take the stress away from you. We do all the number crunching, do the fundamentals, and they just invest on your behalf. There's a changing landscape in that market, and it's good that investors are much more aware of that. And I'm rounding up very soon. For the alternative strategy, we are for these because it helps you to diversify, into real estate, into commodities, into infrastructure, and private capital. Now, this may be a bit more sophisticated for retail investors, right? And that's why we're in the room. So it would be nice. I think the major thing I would say here is that give us a call if you think that you would want us to explore more options with you in the alternative, especially in infrastructure and real estate, and we'll be glad to do so. I'll close us with this charge from Howard Marks, who is the co-founder and the co-chair currently of Oak Tree Capital Management. He says there's only one intelligent form of investing. You have to figure it out. You're figuring it out what something's what, and see if you can buy it at or below the market price. And that's what value is all about. And I think that that's the central point that we have come here with this pricing paradox, looking at the fundamentals as compared to the sentiment. And from where we stand, we see from our crystal ball, we can see that 2025 will present more opportunities for fundamental trading as against the sentiment trading. I hope that you have enjoyed the session. We are open to your questions. Thank you very much.
Thank you very much, Robert. We all needed to hear that. I mean, who doesn't like to make money? I like to make money. I don't know for either of us here. Thank you all from the top, Babajide, Raymond, Temitope Omosuyi, and Robert Omotunde. The session has been quite insightful and informative. And thank you all for staying with us through the presentation. I know we have questions, and we are definitely going to take them one at a time. Thank you. Okay, I think we'll take this one first, and we'll throw this one to our Chief Investment Officer, Robert. So what is your outlook on exchange rates in Nigeria? We know where we are currently, considering the recent electronic platform that was just launched, the IFEMs, and then the recent Eurobond issuance, the 31 and 34 maturity. Considering all of this and where we currently stand, what do you think would become of the exchange rates market going forward? Thank you.
All right, thank you. I know that the question around the exchange rate is such that is not just critical, but it's important for everyone. If my great-grandmother was around, I'm sure she wants to know what the exchange rate will be in 2025, at least so that she can hedge herself. And I'm not going to mince word in telling us. I mean, just looking at the topic we have discussed today, we say pricing paradox, right? Fundamentals versus sentiment. Those two factors continue to drive exchange rate outlook, the fundamentals and the sentiment. Now, let me speak on the less important one. More important, right? But it should be less in terms of pricing, but in an era where there's so much uncertainties, it's more important, and that's the sentiment. The sentiment part is, you know, every investor or every Nigerian is looking at the fact that this time last year exchange rate was probably 40% cheaper than it is right now, but now it's more expensive, and you don't know what to see in the next year. So that sentiment, we want you to stay. Let me stockpile the USD as much as I can, so that at least I protect myself against inflation and, of course, you know, market volatility, right? So that's the sentiment part of it. And, you know, in an environment where it looks like the majority of people have lost confidence in the, should I say, confidence in the ability of the authority to actually put a rein or stabilize the currency. You know, you will always have that every now and then. But the fundamentals basically is to look at what has changed in the Nigerian economy, right? And not much has changed. Not much has changed, to be honest. You know, fundamentals should drive the currency trading of a particular country. And by fundamentals, right, if you look at the sources of accretion to our reserves, from remittances to foreign portfolio investment and foreign direct investments, as well as to what you will see in terms of you know, net exports. That is, when we sell our crude or other items for USD, yeah, you will see that on the oil side, it looks like we have another, you know, set of problem altogether, where the government is not able to increase as much the production because of theft and other insecurity challenges coming in the country, right? We've seen some improvement recently, as announced, but, you know, it's still abysmal relative to what the country can do. So you have challenges on that end. Then remittances, because of pricing, a lot of, you know, individuals are, you know, more tuned to, you know, converting their currencies at alternative windows other than the official window. So you don't get benefits of the remittances. Then you see foreign portfolio investment, which is what the central bank has been trying to do by increasing MPR at every at every meeting since May. As a matter of fact, May of 2022, every meeting you've seen increases in MPR, but it has not translated to, much of foreign portfolio investment as we would like to see. So fundamentally, the country will still be challenged. Last week, the government was at the Eurobonds market to raise money. Gracefully so, markets, smiled at that issuance and were able to raise, more than we had expected to raise. But the point is that when you consider the reserves, right, it looks like, especially when you look at it from the perspective of net reserves, it looks like we still have much problem to deal with in the future. So the outlook on exchange rate is not very great. And from the model that we look at, we don't see an exchange rate that is going to be much better than, a 2,000 naira to the dollar by the end of 2025. So if you can take that projection from us, it could be worse, right? But I don't think it's going to be better than that if you look at it from the fundamental point of view. Now, if you put sentiment into it, you could have as much more than what I've just mentioned, right? That's to tell you that, you can see some news flow helping the currency to stabilize, but it doesn't last. You see moderation in 1, 2, 3 days, at most 2 weeks, and then you see the reversal afterwards. And that is because the fundamentals are still challenged. We will still continue to demand for the USD, and for as long as that demand exists, also because of our exotic tastes, right, we'll continue to see, that challenge and pressure on the currency. Thank you very much. I hope I didn't make you sad. Yes.
Thank you very much, Robert. We believe you did justice to that. So the last question we are going to take now, I believe Temitope Omosi, you would help us through that. So there is this question on the recent inflation trend as we have it in Nigeria. We know it is unrelentlessly going up every month, and the efforts of the CBN to actually, curb this. How has that fared so far? Is it working? Is it proving abortive? Is that the right way to go about it? Really, tell us what you think, and then your outlook on.
All right, thank you very much, Moiba. Generally we have two policy options in every country. You have the fiscal policy and you have the monetary policy. And it has been studied with a lot of evidences that monetary policy is very easy to make, but the impact takes a long time. Fiscal policy takes a long time to make. For instance, you look at the tax bill that is currently going on, series of back and forth, but the most impactful policy on every economy is fiscal policy. E.g. today, if the government announces that our personal income tax has been reduced, everybody on this call that is employed will feel the impact immediately. But when interest rate is increased or reduced, sometimes market just ignores, right? That's on the one hand. On the other hand, that is why we are not seeing much of, and Babajide spoke to that. You saw that increase in, we've seen series of increase in interest rate, but inflation keeps going up. Why? Because of it's obvious that the lack of effectiveness is evident. Secondly, we are talking about a structure in Nigeria where the inflation is driven by the supply side. So the question is, what policy measures has the CBN taken? One, increasing interest rate, right? And how does increase in interest rate address the fundamental factors affecting inflation in Nigeria? We all know that what is affecting everybody right now. Nobody on this call needs to know that inflation is 33%. We all know what's happening in at the market, right? So we know that food inflation is the major problem. So the question is, how has higher interest rate address food supply? As a matter of fact, food producers will even suffer more if interest rate or cost of funding keeps going up. So in other words, we have not seen much of that impact on inflation, right? So even if we continue to push interest rate higher, we all know that even if interest rate continues to go higher from the angle of the CBN, it will still be very difficult to see the impact. But we all know that the onus lies on the fiscal angle to ensure that some of the drawbacks to price stability is addressed. And we all know that we talk about insecurity. We talk about, in fact, majorly food and energy security. How we're ensuring Nigeria that food supply is sufficient, how we're ensuring that energy is sufficient. And when we talk about security of energy and food, we're talking about affordability, the right pricing, and the right quantity. Can people afford it in terms of wages? Do we have access to food and energy in abundant supply? And can we have access to it on a sustainable basis? So these factors that I've mentioned, is obvious to everyone that the only way forward to a sustainable, price stability is on the fiscal side. For next year, we might see 20%, 15% inflation from the current 30%, and that would basically happen on base effect. But everybody will still say that, oh, inflation is dropping, but I'm not seeing the impact on the real wage, on what I can buy at the market. So really, the policy has not obviously that it's not really bringing down inflation. So I think I'll just stop there.
Thank you very much, Temitope. At least we know that we need more than just monetary policies to help battle the inflationary plague we have. That said, that would be the last question we'll take. If we have further questions, we would answer them through emails, and be rest assured that the presentation slides will be shared with every participant. Thank you all for staying with us through the session. We appreciate, and we'll meet sometime again.
Thank you.
Merry Christmas, everybody. I will not forget.
Thank you.
Merry Christmas and Happy New Year in advance. I hope we have a joyous and a lovely celebrations with families. Thank you.
Thank you.